Good afternoon and welcome to our CECL webinar today. Thank you for taking time with us today to go through CECL. And we're gonna really do two things. We're gonna kind of provide an overview of CECL at a high level, and then we're gonna do a demonstration of Bank Trends CECL software. So let me start by introducing our presenters. Of course, one of them is myself, Doug Mims. I'm a partner with Carr, and Ingram. I've been a partner with our firm for 20 years, and I've been in the CPA business for 30. And I spend 100% of my time serving financial institutions and providing financial statement audit, internal audit, and other similar services. I have with me today Michael Stinson. Michael is the president of Bank Trends by Curinos. He founded Bank Trends, previously Spotlight Financial. Michael's been spending for the last probably 3 years or so, he's been spending every day on CECL, showing folks how the software works. And of course, he was one of the, not just the founders of the company, but one of the developers of the software. So he's the expert on the software, and he's going to give us a demonstration here in a little bit. So to provide an overview, CECL to date, kind of where are we? There was an initial exposure draft in 2010, and we've gone through a number of iterations, and there's been some delays and other things, or you know, the due date has been pushed out a couple of times. But where we ultimately landed, I think everybody knows this. I have a chat coming in here. Let me see. Okay, sorry, that's an internal message. I was wondering if somebody was telling me they couldn't hear me or something. Hang on one second. Okay. So ASU 2016-13 was finally issued in June of 2016. And ultimately, the largest publicly traded companies adopted Q1 2020. And that pretty much left everybody else, which really, for the most part, is about 4,700 or so community banks and around 5,000 credit unions out there that still are left to adopt CECL. So that's where we are today. To give you a little bit of a view of the impact of the adoption of CECL, and obviously these are larger institutions, they're all SEC registrants, and so it doesn't necessarily relate to your bank or credit union, but it just gives you a flavor. So as of January 1, 2020 at adoption, the reserve to loans was 1.21% as of quarter end. And this is kind of unique in that CECL was adopted at the same time the pandemic hit. So as a result, the impact, you would presume, would have been larger. And the net impact there, reserves were at 1.47 at March 31st. They were at 1.66 at June 30. And the average increase at adoption was about 36%. Now, what's happened subsequent to that is a lot of those larger institutions have been pulling those reserves back in over time, such that the net impact is probably more like around 20%. But there was an increase in those portfolios. But again, that's not necessarily apples and apples, because that includes, you know, Wells Fargo and other very large institutions that wouldn't necessarily be relatable to your institution. And here's some other data. I think we got a Q&A here. Let me see what's coming in. Tom, Todd, I can look back and see if I have the breakout. I don't recall when I pulled that data. I got it from the AICPA National Banking Conference last year, and I'm not sure how that break is. I can look at it for you and let you know. Okay. I think I need to stay out of the chat in the Q&A. So what are the tools that are out there now that we've all adopted? Really the most relevant ones to you, I mean, you're not a bunch of bookworms, and like me, you don't want to go through all this stuff. What I would say though is there is a FASB, and if you're looking at WARM, and that's what we're talking about today, the Q&A, the FASB staff's Q&A on the WARM method that was issued in January of 2019 is helpful. The FFIEC CECL FAQ that was updated in April of 19 is a very good document. There is an AICPA CECL practice aid out there that has been out for a little while. It was issued in September of 19. And probably the one thing that you probably need to be most familiar with is the FFIEC interagency guidance on allowance for credit losses. Basically, the regulators got together and said, here's what we expect you to do. All of it is, I would say 99% of it, 99+% probably is consistent with the FASB. But there are some things about documentation, about validation, and other things that aren't directly related to the actual financial statement. The actual FASB. So you do need to be familiar when you adopt, you need to be familiar with the interagency guidance because there are additional requirements beyond GAAP, if you will. Okay, so just as a matter of information, the allowance for credit losses is now the name. It's no longer the allowance for loan losses as it has been ever since I've been in this business, but it's now the allowance for credit losses. Similarly, there'll be a valuation account, and it'll be deducted from the amortized cost basis of the asset, and it ultimately the net amount expected to be collected will be what would be presented. That's not really different than today. That is similar to what we do today. And the changes in that allowance flow through net income, and that's the way that we do it today. But it is the allowance for credit losses and not the allowance for loan losses. So just from a math perspective, A plus B equals C. Nothing particularly complex there. I'm gonna go back in the chat again and see what we have. I believe that the materials are attached to, I think you can grab them. If not, they'll be distributed after the webinar. Okay, so the more things change, the more they stay the same. So today, asset classes, so and think about this from a community bank, smaller credit union, I say smaller, maybe under 2 billion perspective. So asset classes have required estimation methods. Pooling is permitted but not required. And the big thing is losses are recognized when they're probable and estimable. Under CECL, there's a single impairment mode. Pooling is required. Reasonable and supportable forecasts are included, which is different than what we do today. And there's no threshold to recognize losses. And when it says threshold, we're not talking about dollars, we're talking about probability. So once you calculate your estimated loss, it doesn't have to be probable. There is no barrier to cross. You would recognize or record your allowance accordingly. So there are no complex estimation models required. You do consider past events and current conditions. We do that today, and it requires judgment. And I may be a little bit ahead, but if today you're pulling your assets, say by call code, and you pull them and you calculate your historical losses, which most folks don't have a lot, but you do calculate what you have, and you apply that percentage for your historical losses. And you take qualitative factors that are consistent with the FFIEC guidance, and you apply those qualitative factors to each of those pools to come to your loan loss reserve, you're considering past events and current conditions today. That's no different under CECL. It's the same exercise. So the only piece that is different under CECL is the forward-looking piece. And in particular, when we look at the WARM method, you'll see that it is very similar to what the incurred loss model does today for most community banks. I'm gonna go back in the chat again. Paul says the link does not work. So that's a job for not me. Nathan will take a look at that. All right, so CECL only changes the loss, the timing of loss recognition, not the amount lost. Theoretically, and I'm not saying practically, but theoretically, today, you recognize losses as they are probable and estimable. And well, really, when you charge them off, you actually charge off from the reserve, but you're providing for them as you go based on your estimation and the probability. Under CECL, theoretically, you would recognize those losses on day one of the loan, which doesn't change the total loss to be recognized. It simply theoretically changes the timing of the loss. Okay, and just kind of to get a visual and basically what I just said today under US GAAP, you've got your unadjusted historical charge-off percentages, your qualitative adjustments, your loss emergence period, by loss category, and that's your allowance. Under CECL, you're going to have the same. You're going to have historical charge-offs. You're going to have your current and your forecasted amount. So your current and your forecasted amount by loan category to get to CECL. So similar from a practical perspective. So I'll touch on this briefly because I know trying to make sure I keep my time right. We want Michael to have plenty of time to do what he needs to do. But so historical losses, past events, same as today. And it's presumed under the standard that historical credit losses generally provide a reasonable basis for your reserve. However, you have to consider adjustments. So shall consider adjustments for differences based on current specific risk characteristics within a pool, the contractual term of the individual loan or pool, and different economic conditions. Common adjustments to historical credit loss information include changes in underwriting and historical losses from a different point in the credit cycle. So really the common adjustments that are used today would still be applicable. If you look at the FFIEC guidance that everyone's using today and compare it to the qualitative factors that are in the new guidance that was issued that I referenced earlier, they're very similar. There are some differences, but there's there's certainly more similarity than there are differences. Go to the chat again. Okay, that's all right. So past events, similar to what we do today. Current conditions, also known as Q factors. So qualitative adjustments are permitted under CECL. They're not required, but you would presume that your historical losses wouldn't necessarily reflect the losses that you have inherent in your portfolio. But you do build qualitative factors in, which I know is repetitive. The data you use for those Q factors can be internal, external, or a combination of both. Internal information may be sufficient and/or more appropriate. The available information may relate to past events, current conditions, or reasonable and supportable forecasts. So much like what we do today, you can use the data available to you. So if you have data available, if it results in an appropriate reserve and you think it provides a reasonable basis for your reserve, then you can use internal information, but you can also use external sources. I think today that most people use a combination of both. I'm gonna skip past that. Okay, so looking ahead is the perspective piece. So from a forecast perspective, you have to consider relevant quantitative and qualitative information in assessing collectability. The information for that too can include internal and external sources or a combination thereof. And so it's not that, again, that's not that different than what we do today. So for forecasting purposes, you need to use the information available to you, and we'll look at in a minute when Michael goes through this, what that might look like when we're looking at forecast, how the forecast looks, and the period that you would look forward, and some of the components. It'll be a very practical example for you. So I'll kind of blow through this a little bit. Okay. So the warm method. So under CECL, there's a number of ways you can do it. You don't have to use complex models. You don't have to use any particular method. The warm method is what we're talking about today. The FASB put out a Q&A and said that it did comply with GAAP. The regulators have said that they find the warm method acceptable. They actually had a separate webinar devoted to the warm method. So they didn't endorse the warm method, but they did say it was appropriate. And I think there's not a presumption that you'll use it. There's not an endorsement, but there certainly has been, they seem to like the warm method. or else they wouldn't have pointed that out. You can also use the snapshot or open pool method. You can use the vintage method, which tracks by year of origination. You can use a probability of default or loss model, or you can use discounted cash flow. So those are just some of the different ways that you can do it. And again, today we'll be talking about warm. So the remaining life method, which is the warm method, utilizes the average annual charge-off rates and remaining estimated life to calculate the allowance. For amortizing assets, the remaining contractual life is adjusted by the expected scheduled payments and prepayments. Average annual charge-off rate is applied to the amortization adjusted remaining life to determine the unadjusted lifetime historical charge-off rate. So you take the average annual charge-off rate times the amortization adjusted remaining life, which gives you the lifetime historical charge-off rate. So here are some of the factors you should consider if you're looking at the warm method. How complex is the pool of assets? What is the contractual term of the pool? What extent of the loss history is available? Are the losses sporadic with no predictive patterns? How many loans are in the pool? Does the composition of the pool vary significantly from historical pools of financial assets? I think when most community banks ask themselves these questions, the answers are such that it would make the warm a viable option for them. Not a predetermined answer, but certainly it would be a viable option for most community banks. So some of the practical considerations, and so I think we're past the point of any further delays on CECL. I think 1/1/23 it's coming, and there is an expectation that you'd be running parallel in 22, at least some portion of 22. I don't think there's going to be and this is just my opinion, but I think the common thought process is that CECL is not going to be further delayed at this point. You need to make sure at this point, have you identified the ownership of CECL and developed a timetable? Do you have a data game plan? Have you identified a third-party partner? I hope that most everybody has gone through the first 3 bullets, and maybe you're still, you're comparing between third-party partners or thinking about doing it yourself. Does your timetable include running a parallel beginning Q1 of 22? And then I really think that one thing I would leave with you as we go through this process is there is an opportunity here, even though CECL is different, it is cumbersome, it has already taken resource away from your institution, and there's probably going to be both opportunity cost and direct cost going forward. There is an opportunity to continue to improve your processes, to break down silos and align financial reporting with your credit risk management function. So, and Michael will speak to some of that as he goes through the demo. So this is a little overview of the CECL dashboard. I'm not going to steal Michael's thunder, and I'm going to stop babbling and let Michael jump in and show you all what I was attempting to explain a little bit.
All right, thank you, Doug. I'm going to try to share my screen with you all. So hopefully on your side now, you're able to see our CECL toolkit. So this is really meant to give you an overview of what we've put together to help address CECL for community banks and credit unions. We like to call this the easy button for CECL, but really what we've tried to do is, keep things very similar to what y'all are doing now under the incurred loss method. Obviously incorporate the new wrinkles that are coming with CECL, and then really turn this into a more modern and web-based approach to doing the calculation, because a lot of the banks that we talk to, I'd say 90% are doing this in a spreadsheet. The spreadsheet that they're using has probably been, in use for the last 10 years. So this is really an opportunity, if you're looking for a silver lining of CECL, to upgrade your process to a more collaborative approach where everybody can kind of be involved in, putting together the calculation in this web-based tool that we're looking at today. So basically what I'm showing you is our CECL toolkit. So in the demo, we'll spend most of our time talking about the allowance calculator. But as Doug mentioned, there is a forward-looking component of CECL that you're expected to essentially quantify how future economic conditions impact future charge-offs. So this forecaster model is really meant to serve as our crystal ball around the forward-looking piece of CECL. And then, as Doug mentioned, qualitative factors are still going to be an important part of your calculation. So the couple reports at the bottom are some peer reports, and these are really meant to help you support your qualitative factor adjustments through some peer data. That's what the regulators said that they're expecting from you, so we tried to build that in. And then over here in the resources section of the menu, we give you some workbooks that can, really be best practices templates for tracking your impaired loans, or this other workbook can help you come up with your qualitative factor adjustments. And then we also give you an overview document, which, the idea is basically you could print this out and put it right into your policy documentation for the reserve. But it describes the WARM, or the weighted average remaining maturity method, that we use in our model. I think a couple slides back, Doug mentioned that there are a few options available to you for CECL in terms of methodology. But really the WARM method is really the only option that works with call report data. So that's one of the reasons that we decided to choose WARM. But we can't do 100% of the calculation straight from the call report data. There would be some items that you all would be adding, and this document lists what those inputs are, and I'll speak to those more as we go through this. And then we also give you an example of the payment calculations here that we're using to do the forecasting in the model. So last thing I'll mention is that, I guess, on top of the software and the modeling that my team provides and supports, the subscription also includes consulting hours with Doug and the folks from CRI. So we really like to think of this as like a best of both worlds approach, because you get some top-notch modeling software, but you also get the expert guidance in terms of how you all are actually going to implement CECL at your bank or your credit union, and really think things through from like an exam or an audit perspective, because ultimately CECL is going to be more than just coming up with a calculation. It's going to be a process that you're going to be implementing at the bank as we move into 2023. So that said, I'm going to show you an example of what a bank looks like in the model. I would say one of the nicest benefits of using the WARM method is that we can do a lot of the heavy lifting for you from the call report information. So I probably do 5 demos a day, and, everybody that I talk to has basically been gathering data for the last 5 years, but they don't know what to do with it. That exercise is more or less eliminated when you choose to go with the WARM method, because, like I said, we can do a lot of the heavy lifting for you from the call report. So we're going to look at this bank from Illinois as in our guinea pig today. But basically, you can see that when the model loads, we're showing you a gray box, which is where the reserve was at the end of the second quarter. This is their call report data. And then in the blue box, we're basically coming up with a baseline calculation of where the reserve would be under CECL, looking only at that 11 years of loss history that we're pulling in from the call report. So initially, this $2.8 million number in blue would represent the historical or the loss rate component of the reserve. And then on top of that number, the bank would still build in or add in their qualitative factor adjustments, their impaired loan adjustments, and then their economic forecasts, with the end goal of, more or less getting the blue box number, close to the number that's in the gray box. So from a practical perspective, when you use this model, the first step would be to determine your look back period. So what we're really using the call report data to do is to calculate a loss rate for each of your loan portfolios. And in order to calculate a lifetime loss rate, we have to determine a look back period. So here in the model, you basically have the ability to choose when the look back period starts and how far back it goes. And if you change it from the default of 11 years and you shorten the look back from, 44 quarters down to 30 quarters, or even go shorter than that, for this bank, it really has a material impact on the number that comes out of the blue box, because when you go back to that loss history chart, you can see that, for the last 6 or 7 years, it's been pretty smooth sailing at the bank. And when we shorten the look back period to get rid of some of these losses from 2012, 2011, that is ultimately what impacts the number that comes out of the blue box to begin with. So, The look back period is important. The accounting guidance says that that is an institution specific decision that you all would need to basically decide upon. And I think the magic words are, so long as it's reasonable and supportable, the guidance is that you're supposed to pick out a period of your historical data that is in line with how you expect your portfolio to behave going forward. So ultimately, what I'm trying to explain is that this model is dynamic and flexible, and to some degree, what comes out of the blue box is going to be a function of what you put into it. And determining that look back period is really the first important user decision that you all would make. But basically, once you set the look back period, and in this case, we're just going to choose the full 11 years of history that we're pulling in here by default. Then when we go to this allowance elements tab, what we're calculating for you from the call report data is the column here for the expected lifetime loss rates. So these numbers get calculated, like I said, automatically from the call report data. The two drivers of the loss rate calculations will be the look back period that we establish, in this case, 44 quarters, plus the column here for the weighted average remaining maturities. So the worms are going to be an important input. This is not something that we can come up with from the call report data. So what we've basically done is we've built in some industry average numbers so that the model works out of the gate. But the assumption is basically you're going to be able to pull portfolio level data from either your asset liability management software, or alternatively, we could help you calculate those off of one of your loan files. But either way, you're going to come up with the worms. And then once you have that data, then that's going to be another user input that you add to the model. So for example, if the weighted average remaining maturity on your first mortgage portfolio was closer to 7 years, rather than the 20 quarters that's built in here, you'd come into the user inputs and then you'd update the 20 quarters to 28, and then that gets baked into the cake as far as the calculation is concerned. So the weighted average remaining maturities are an important input. Probably the most important input that most banks that I talk to are going to be adding is the column here for the qualitative factor adjustments. So the Q factors start out at 0. This is something that you're going to be adding to the model. And assuming you all have a good process in place already for the qualitative factors, then that's also something that you basically plug into the user inputs tab of the model. And I mentioned we provide a Q factors workbook to assist with the qualitative considerations. If that's something that you'd like to see, just send me a note in the chat and we can look at that during the Q&A section. But assuming you have a good process for your Q factors, then that's another input that's going to go into this user inputs tab. So, just to illustrate, if you wanted to add like 50 basis points of qualitative factors on top of the loss rate for the first mortgages, you key that in. Maybe we'll add, 75 basis points to the owner occupieds and 100 here to the non-owner occupieds. You'll notice that as I build in those qualitative factor adjustments, then that changes the number in blue. And that's because the qualitative factors will get layered on top of the loss rate from the call report data. And then that becomes the new total expected lifetime loss rate for that portfolio. So I guess, I'll spend a little bit more time talking about the qualitative factors because they are, going to be an important part of the calculation. A lot of, folks I talk to think that Q factors may not be a part of the calculation under CECL, but they certainly will be part of the equation. I would say under CECL, the regulators, the auditors are going to give your qualitative factors, probably an even, heightened scrutiny as compared to what they do now under the incurred loss method. And I think, the way that we explain qualitative factors when we give these demonstrations is that it's going to be a 2-layered approach under CECL. So the first layer of qualitative factors, that's what goes into the column here in this part of the model, represent the current condition adjustments to your lifetime loss rates. So those are the factors that Doug was basically walking us through here just a minute ago. And then the second layer of qualitative factors would be the economic adjustments. So these are new to CECL, and the ask is basically that you're going to quantify specifically how future economic conditions will impact future charge-offs. We'll talk about those more in just a minute when we get into the charge-off part of the demo. But I know that a lot of folks are, probably considering like unemployment rates or GDP numbers as part of their current condition adjustments. But in this model, we're really separating that into their own kind of second layer of qualitative factors. Before I get off kind of the Q factors high horse, the last thing I'll mention is that within the model, we calculate some peer group data for you automatically. So by default, we're going to calculate a peer group that represents banks from your state that are plus or minus 35% of your asset size. As a client, you can certainly customize the peer group and use whatever banks that you'd like. But typically the defaults are pretty good sample size. And for this bank in Illinois, the default peer group is actually 59 other banks, and it represents about almost $16 billion in aggregate loans. So the idea with the peer data is that these loss rates represent a bigger slice of the economy than the 300 million in this bank's book. So I would say most folks that are, building in a qualitative factor adjustment in order to beef up the number in blue are typically going to attribute, a portion of the overall qualitative adjustment to the loss rates that the peers are experiencing. So that's basically the Q factors, the peer data, and up to this point, what we've done is not a whole lot different than what we're doing now under the incurred loss method. Basically, we set a look back period, we added our WARMs so we can calculate a loss rate for the portfolios, and then we adjusted that loss rate with a qualitative factor adjustment. The difference for CECL is that you need to forecast these losses out into the future. And in our model, that's what's going to happen in the future losses tab. Before we go there, I just want to cover the last of the user inputs that we would need from you beyond what we can gather from your call report. So we've already discussed the WARMs and the qualitative factors. The other things that you guys would be bringing to the table would be the annual prepayment assumptions, the percentage of the portfolios that are interest only, and then the weighted average interest rates. So the numbers that start out in this column or these columns are either industry average numbers, or we're calculating the interest rates from the call report data. But the assumption is that these are just placeholders until you can key in your own data from your ALM system or your interest rate risk model. Or like I mentioned at the beginning, we can calculate these for you from one of your loan files. Probably the last user input that you'd be adding would be the column here for the alternate principal balance. So this column is important because it lets you do the calculation between your call reports. So if you're doing the calculation monthly, you continue that frequency by updating this column of balances with month-end numbers. Even if you're doing the calculation on a quarterly basis, you're still typically going to come into the model, update the balance column with quarter-end numbers, calculate your allowance, book your reserve, and then you would file your call report. But that's pretty much the extent of the user inputs. Once those are added to the model, then it's the future losses tab where we're actually calculating the reserve under CECL. And the way that's happening here is that we're taking that total expected lifetime loss rate, which is again, the loss rates from the call report data, plus the qualitative factor adjustment. We're converting the lifetime loss rate into an average annual loss rate. And then we're multiplying that average annual loss rate out into the future against a portfolio that's getting smaller. If I kind of explain that just a little bit differently, all of the user input data that you all add to the model lets us build an amortization schedule so that we can forecast the principal balances for each of these portfolios each year into the future until they've paid down to zero. And then we're calculating an expected incurred loss each year that the portfolio has a balance. And again, the number of periods it takes the portfolio to pay down to zero is determined by the weighted average remaining maturity that you all enter into the model. So that's why the WARMs are so important, is because they really, drive that pay down schedule. But this is really the first main difference of what's new under CECL, versus what we do now under the incurred loss method, which is forecasting losses against declining principal balances. And I know, just as an aside, a lot of the folks that have signed up for our model that really tried to do this in-house in a spreadsheet, it was this, building the amortization of the pay down schedule, which was really the stumbling block that, led them to basically take the path where they didn't want to reinvent the wheel, more or less. So if that's the first main difference of what's new under CECL, another difference is that your impaired loans will fall under a category called loans with dissimilar risk characteristics. What makes a loan dissimilar will be up to you all to determine, but this non-pooled loans tab is basically where you can carve out and reserve specifically for individual loans or groups of loans. So definitely your impaired loans will fall under this category. You might include, the substandards or the watch list loans that are not yet impaired. If you all have done any PPP loans, you might carve all of those loans out and reserve nothing for them if they're 100% guaranteed. Basically, this non-pooled loans tab gives you the flexibility to segment the portfolio beyond the classifications that are inherent to the call report. Just as an example of what that looks like, let's just say for this bank, they've got about, 114 million in their C&I portfolio. Let's say 14 million of those were impaired, or 14 million of those were made outside of their normal lending geography, so they behave differently than the rest of the portfolio. Whatever the reason, you'd come up with that balance that you're looking to carve out. In this case, we're going to say it's 14 million. You'd also come up with a specific reserve for that balance. So if that specific reserve turned out to be, I don't know, let's say $295,000, whatever you key into this non-pooled loans tab is going to flow through the whole model. So when you go back to the spreadsheet, you can see that we've pulled the 14 million out of the balance for the C&Is. We've dropped that here into the specifically allocated line. And then the reserve for that 14 million is here, which we then add to the rest of the expected losses in this column. So I'd imagine that process is not too dissimilar from how you all handle your current impaired loans, assuming you have any. Kind of the last piece of, I guess, the CECL puzzle, and I talked about this earlier, would be those economic forecast adjustments. So that's what's going to go into the 12 and the 24-month boxes in this user inputs tab. And what goes into those boxes is, probably going to be influenced by what comes from our charge-off forecaster. So this is the crystal ball I talked about earlier. I would say that when we started reading through the accounting standard, it was really the economic piece that we thought would be the most intimidating for a lot of the banks that we work with, because the FASB is, essentially asking you to do a regression analysis. So this model automates that part of the puzzle for you. So what we're basically doing here is we're pulling in loss history, going back to about 2006. We're looking at loss history for the entire banking industry over that same time period. We're also pulling in some leading economic data from the conference board. We're doing a whole bunch of fancy math, and the end result of that math for this first secure bank in Illinois is that we actually don't expect any increase to charge-offs over the next 12 or 24 months based on the economic data that we're pulling in here from the conference board. So, if you are at this bank, you may end up disagreeing or agreeing with our forecasts, but essentially these 0 basis points will serve as covering what you're being asked to do from a math and a science perspective when it comes to CECL, and then giving you the starting point to adjust these numbers up or down based off of what you know about your local economy or your individual borrowers, or maybe any other economic data point that you're considering that's not already being considered in this leading economic data. So we pull from the conference board their leading economic index. This index is updated on a monthly basis, and it's meant to give us an indication of where the economy is headed by looking at 10 components of economic health. So these are things like, weekly unemployment insurance claims, or new building permits, or stock prices, or credit spreads, or yield curves. The leading index is highly correlated to losses nationally for all banks. We basically step in to determine the correlation coefficient and apply that regression analysis specifically to your institution. And like I was showing you, the end result for First Secure Bank is that, no change to charge-offs over the next 12 or 24 months. As that relates to the model, assuming you agree with those forecasts, then basically you leave these numbers at 0. If, however, you thought, COVID was going to do more damage to your portfolio than what we're, predicting, or if, you knew a big manufacturing plant was about to close down, it was going to affect a lot of borrowers. Ultimately, this is like a second layer of qualitative factor adjustments. What goes into these boxes is going to be up to you all to determine. But you'll notice as I build in those forecast adjustments, then that gets, baked into the cake, so to speak, from a calculation perspective. So that's really the steps of going through the model to come up with the calculation. Once you get the number where you'd want it to be, you'd basically save your scenario. So next month or next quarter, when you come in here, you're going to pick up right where you left off. I would say the first time you work with this software, like with any new piece of software, there's a bit of a learning curve, and that's when you're going to pull in your warms, your prepayment speeds, and so forth. So the first time around, it will probably take you a little bit more time than normal. But the workflow the second time around would typically consist of updating the impaired or the non-pooled loans in this tab. And then in the user inputs, you'd probably update with your quarter end or month end balances. You probably tweak the Q factors a little bit, and then maybe make an adjustment to the economic forecasts. As far as the warms, the prepay speeds, those aren't likely to change materially month to month or even quarter to quarter, just depending on how quickly your portfolio is growing. And then we also assist with your documentation. So we provide you with essentially a narrative template. And the idea here is that you would spend some of the consulting hours that are included with CRI to customize this narrative to your situation. But once you've done that, then basically each time you do the calculation, you take a screenshot from the model, paste it into the Word document, and then update the commentary to reflect what changed since the last time you did your calculation. And I would say that the 3 documents or the 3 files you're likely to save off each month or each quarter would be this narrative with the commentary and the screenshots. 2 would be the spreadsheet you're using to keep track of your qualitative factors. And then 3rd would be the spreadsheet you're using to keep track of your impaired or non-pooled loans. But that is pretty much what we had wanted to cover with you as far as, using the model to calculate the reserve under CECL and the steps that go into that. I think as far as the demo perspective, I'm done. So I think maybe we have a poll question coming up. And here is that poll question.
The Michael, after the poll question, one thing that might be good is to show them the due diligence information and that you all have housed in there, so that they can see how user friendly that is. And the validation and the other things that y'all have built in there. And then also, and you may have mentioned this on the front end, and the videos that you all have, the instructional videos, I found those very helpful for myself when I first got in there and was playing around trying to gain an understanding. Those are very, very user friendly.
Yeah, definitely. I don't know how long we want to leave this poll open, but yeah, I can certainly cover that stuff here. Let's see. So we've tried to really make this as user friendly as possible. So the idea is that a lot of this is, more or less self-service. My team is ultimately going to support you when it comes to using the software. So we're definitely not leaving you on your own. We support you every step of the way in terms of using the software. And then we also include, like I mentioned, some consulting hours with Doug and his team to really help with, the technical accounting aspects of CECL and developing your strategic and your tactical plan between now and your implementation date. So when it comes to kind of the onboarding, If I go back to our menu page here, we basically have a number of tutorial videos that will help you get onboarded and up and running. We've also put together a help center, which is a centralized resource for a lot of the questions that have come up over the past couple of years. So this can help, understand the math behind the loss rate calculations, or, mapping, if you're a credit union, the portfolios in the model to the 5300 call report. But ultimately, like I said, we would support you. So typically, we would get you onboarded, let you play around, gather the user inputs, get familiar with the software, and then we would schedule a training session. And then once we go through that training session to answer any questions that you have about using the software, then you're typically ready to schedule that first consulting session with the folks from CRI. But whenever you're in the software, I would say that you can always hit the support button. That brings open a live chat with me and my team. We've all got young kids, so nobody ever sleeps. Those messages come straight to our phone. So as long as we're awake, we'll definitely answer those questions that you have. But more or less, I mean, it's designed to be pretty user friendly. I actually designed and programmed everything. So I like to think that it's pretty easy to understand, but if it's not, then, I'm the first person that answers the phone when you give us a call, so I can help you out. Does that answer, Doug, what you're hoping to get?
Yes. Okay. I'm looking in the chat, see, do you have a tool that uses discounted cash flow model? Meant to say discounted cash flow methods. So I think that's probably a question for you, Michael. Do you all have a tool that is a discounted cash flow?
No, I mean, there's a lot of other vendors that will offer a loan level solution. Our model uses call report data and the warm method, because really for the warm method, that's the only option that works with call report information. If you wanted to use the discounted cash flow, that's going to require loan level information and typically some sort of, outside database to keep track of that much detail. So there's a lot of other vendors in the marketplace that will provide a discounted cash flow analysis model for CECL, but typically those are multiples of what we charge for our solution. And if you're like most community banks, it's all going to come down to your qualitative factors anyways, regardless of which methodology you end up selecting. So I know for at least the banks that I speak with, it really doesn't make a whole lot of sense to spend an arm and a leg and really have to hire an FTE to run a loan level solution when you're not going to really find anything much different than what you're going to get out of the call report data to begin with, especially when it's all going to come down to your qualitative factors at the end of the day.
Okay. Another question, Michael, that can warm be applied to loans or loan pools that aren't amortizing assets, like a balloon loan with just interest only payments?
I would defer that to the actual CPAs on the call.
Yeah.
I know that we have an article written about how we handle loans with the balloon periods, but technically within the model, we would probably make an adjustment to the prepayment speeds. But I mean, basically, for the model, we're using the contractual maturity of the loan. And then in this article, it says we make a qualitative factor adjustment to the loss rate to account for any risk due to the short-term duration of those loans.
Well, and if they're dissimilar, meaning they have different risk characteristics, they also might be a candidate for pulling out of the pool and placing them in a separate pool by themselves to be evaluated separately, right? I mean, that's always an option. Anytime you think that a loan doesn't have the same risk characteristics of another loan, and presumably they wouldn't if they're structured differently, which is why they structured them differently when they underwrote. So yeah, that's still a possibility. The warm method assumes a homogeneous portfolio by loan type, correct? I would say the warm method, like every method, assumes that the pooling that you use is that the loans in that pool have common risk characteristics. In this instance, this tool uses call report data because there is a presumption that call report that those loans have similar risk characteristics by type. But again, anytime you feel like there is a loan or group of loans that don't share similar risk characteristics with a call code pool, you can pull them out. that fair, Michael?
Yeah, and I think the regulators made it very clear in those webinars that the call report loan classifications are a great place to start for most institutions. And then, like you were saying, Doug, you can certainly pull out those, subsections within the model using that non-pooled loans tab if you wanted to reserve for, that subsegment differently than the rest of the portfolio. So certainly possible within the model to do that in the non-pooled loans tab.
Gotcha. One other question. It says, you mentioned you could possibly use our loan files to obtain some data. What is this process? And I'll let Michael speak to that first.
Yeah, so as I mentioned at the beginning, we do need some, I guess, data beyond the call report in order to really customize the calculation. And the things like the weighted average median maturities, the prepayment speeds, the percentage of the portfolios that are interest only are typically found in your asset liability management software. So that'd probably be the first place to look. But for a lot of folks that use our model that we're not able to, very easily obtain that information, we built essentially a calculator that would run off your loan files to come up with all of the user inputs that we need to, basically dial in your CECL calculation beyond what's in your call report. So that process would basically depend on what core system you're using, and if the loan extract file you're able to pull from that system meets our specifications, and most importantly includes the call report loan code within that extract file. And if that's the case, then we can certainly help you come up with the user input calculations, but it would probably require kind of a separate meeting with someone on my team to just make sure that your loan extract file has exactly what we need to make those calculations.
Michael, did you touch on the model validation earlier?
No, I didn't. So basically the nice thing about using call report data is that all of this information ties back to your regulatory filing, and you can export this data, the underlying data, to Excel to tie that back to your call reports. And ultimately, we could help you understand the math behind how we're calculating the loss rates from the call report data. It's definitely not rocket science. But in order, from a compliance perspective, for everything to be buttoned up, we have obtained a model validation from a third party so that you're confident that the numbers are what we're saying they are, because they've been evaluated by a third party. So if you end up using this model, we'd certainly make that validation certificate available to you, so you could include it as part of your due diligence or what you show to your auditors or your examiners.
I'm just looking to see if there are. That was a question in the Q&A, and then
I think one other thing maybe to mention, Doug, is you browse through if there's any other questions. This model only takes in call report data or aggregated internal data at the call report classification level. So there's no customer level data. There's no personally identifiable information in our model. So that really reduces a lot of the compliance burden from our side, because we're not pulling in a lot of sensitive data that some of these other vendors you may be working with are.
Yeah, I mean, one of the big differences between what a lot of banks are doing in practice today, I mean, you can, in looking at the look back, the data automatically filling in, the ability to look at the impact over different look back periods. Today, that's essentially a manual process if you're using a spreadsheet. The question come in, what do you think about the Federal Reserve Bank scale method and tool? I would say I participated in the webinar, and I've looked at all of that information. I think there's still remains a lot of questions around scale. I participated in the AICPA National Banking Conference last week. I think the week before in DC, and it was covered by the Fed. They went over it. The OCC was there. The FDIC was there. It was made clear in that live venue that the scale model is truly a starting point for a small community bank, and it's not real clear what they say you can't use it if you're over $1 billion. I would I would think that scale would apply to a much smaller bank than over $500 million or something like that. I think you're probably getting to a smaller asset size. But from my perspective, and this is just not the firm position, my position, if you use the warm method, you start with your data, your historical losses, your loan pools. If you start with the scale, you start with peer data that is combined data, and it includes both historical losses from other institutions as well as their qualitative adjustments. For me, I think I would want to start with data I know. I mean, there's a challenge here to begin with, but if the starting point is trying to figure out what data you're actually using as your starting point, that seems to me to be challenging. And getting that data to become GAAP compliant, because standalone it's not GAAP compliant, and that's been emphatically stated. That just seems challenging to me. I would rather start with my data, whatever method I used. I'd rather start with my data if it were me. Michael, you might have some add to that.
I mean, I think it's a option. It's a free option, so that's definitely appealing. I think the issue that we would have is that even though it's free from a cost perspective, there's still a lot of time and resources that go into getting the peer data. So the peer data comes from banks that have already implemented CECL. So these are, very large institutions that don't have a balance sheet that's reflective of a typical community bank. And they typically have loss rates that are much higher. So you're basically starting with peer data that doesn't represent your portfolio. And ultimately what you're going to be doing is adding a negative qualitative factor adjustment to bring the loss rates from the CECL implementers in line with what you think your portfolio will behave going forward. So there still will be qualitative factors either way for most banks, but the difference with scale is that you're going to be putting in a negative Q factor, and I think those are a lot harder to justify. I know that, secondly, when scale first came out, we went through the process of trying to pull the call report data for the CECL filers so that we could, basically implement the CECL or the scale method in the spreadsheet that they gave out for free. I mean, that ended up taking us almost the full day to pull that data in there. So there is still a question of, support around the model. If you have any questions, who provides that? Because it's certainly not the Fed coming up with an 877 hotline to do that. So I think, it's very nice that we've partnered with CRI to really provide the guidance on top of ultimately the model that you'll be using to come up with the calculation. So either way, there's still some work.
Well, in our markets in the South, we're across the South, and in the markets where we serve banks, most of those banks are either national charters regulated by the OCC or they're state chartered Fed non-members. So their primary federal regulator is the FDIC. So the OCC and the FDIC is commonly what we see, recognizing that the Fed supervises all holding companies. If I were going down the path of scale, the next time my examiners are in or in my dialogue with them, I would talk to them about that, particularly if you're an FDIC bank or an OCC bank, and make sure there's been no endorsement of scale by the OCC or FDIC. They've not said it's not okay, but they certainly have not endorsed it, and they were not part of that webinar that took place. And I don't know if that was if they just didn't happen to be there, or if that's an indirect way of saying that they don't love it. I don't know the answer to that, but I would ask the question before I go down to that path. The last thing I would say about this whole process is, as Michael was saying, there is no magic pill. There's work here. And even with a great tool like Bank Trends, there's work here on your part. Is there, do you have to reinvent the wheel with the warm method in this tool compared to what you're doing? No, actually, you already have a lot of this information. The qualitative factors that you're using today, you're already, pooling by risk using call codes. There's a lot of similarities in that stuff. So but there is still work. The other thing that's in development, and I encourage you to do this, whoever your financial statement audit firm is, I encourage you to be having an open dialogue with them, whether you're going down the path of Bank Trends, Scale, any of the other vendors, whatever you're doing, I would keep an open dialogue. The AICPA is putting out an audit guide specifically for CECL. and it is not yet final. It's in draft form. It's coming out, and having privy to some of that information, I would say the bar is pretty high as to what we as auditors are supposed to do when we have on the audit hat, not the consulting hat. So I would encourage you to keep that dialogue open with your auditors, because they're going to have the bar is a little bit raised in this, and I think it's going to be raised from a regulatory perspective also. Well, let's see if I can. Looks like we've gotten all the questions, I think. Let me make sure all the chat's clear. And we certainly appreciate everybody's time today. Michael, thank you for your time in the demonstration. Hope everybody found it beneficial. And as always, please stay connected with us and reach out to us if we can be of assistance. But thank you all, and have a good afternoon.
Thanks.